Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is March the 7th, 2026. Last week, we explored the concept of duration, the measure that tells you how sensitive a bond's price is to changes in interest rates. We learned that Frederick Macaulay gave us this essential tool way back in 1938, and we saw how devastating interest rate moves can be when we looked at the 2022 bond market's performance. Today, we're wrapping up our debt security series by putting everything together, how to actually build a bond portfolio that serves your financial goals. Over the past 14 weeks, we've traveled from Mesopotamian clay tablets to modern credit ratings, from ancient promises scratched in cuneiform to sophisticated measures like yield curves and duration. Now comes the practical question. What do you actually do with all this knowledge? Well, let's start with the fundamental question. Why own bonds at all when stocks have historically delivered higher returns? Here's what it comes down to. Bonds play three distinct roles in a portfolio. First, bonds provide income. Unlike stocks, which may or may not pay dividends, bonds contractually obligate the issuer to make regular interest payments. Predictable cash flow matters in many portfolios, especially as you approach or enter retirement. Second, bonds provide stability. Remember our discussion of the inverse relationship between interest rates and bond prices? While that relationship creates risk, bonds are generally less volatile than stocks. When stock markets plunge, high-quality bonds often hold their value or even appreciate as investors flee to safety. Third, bonds provide diversification. Stocks and bonds don't always move together. During the 2008 financial crisis, while the S&P 500 fell nearly 40%, Treasury bonds actually gained in value. That negative correlation, when one goes up while the other goes down, can smooth out your portfolio's overall return considerably. For most individual investors, bond mutual funds or exchange-traded funds offer a more practical path to owning bonds than buying individual bonds themselves. A single total bond market fund might hold thousands of different bonds, from treasuries to corporate bonds and mortgage-backed securities, spreading your risk across many issuers. The typical expense ratio for a broad market index fund runs around 0.03% to 0.05%, or, as we learned, 3 to 5 basis points annually, meaning that you pay just $3 to $5 per year for every $10,000 invested. You can invest with as little as $1 through fractional shares and buy or sell any business day. Compare that to individual bonds, where the minimum is typically $1,000 per bond, and building a diversified portfolio, well, that requires tens of thousands of dollars. However, individual bonds have one significant advantage. If you hold them to maturity, you eliminate interest rate risk entirely. You know exactly what you'll receive and when you'll receive it. Bond funds have no maturity date. They constantly buy and sell bonds, so you can't simply wait out a period of rising interest rates the way you can with an individual bond. Oh, and for investors who want to buy individual Treasury securities directly, treasurydirect.gov allows purchases with a minimum of just $100 without paying any brokerage fees at all. Now, here's an approach to owning bonds that combines the benefits of both individual bonds and bond funds. Instead of putting, let's say, $50,000 into a single bond maturing in 10 years, you might buy 5 bonds of $10,000 each, maturing in 2, 4, 6, 8, and 10 years respectively. This is called a bond ladder. As each bond matures, you reinvest at the long end of the spectrum. When your 2-year bond matures, you use the proceeds to buy a new 10-year bond, and this maintains the 2, 4, 6, 8, 10-year ladder. This also provides regular access to your money. It averages out your interest rate exposure over time, and it gives you the certainty of known maturity dates, a combination that's really hard to replicate with bond funds alone. Now, how much of your portfolio should be invested in bonds? Well, there's no universal answer to this question, but several popular guidelines exist. One suggests subtracting your age from either 110 or 120 to determine your stock allocation, with the remainder placed into bonds. Under this approach, a 30-year-old might hold 80 to 90% in stocks and only 10 to 20% of their portfolio in bonds, while a 60-year-old like me might hold 50 to 60% in stocks and 40 to 50% in bonds. The logic is straightforward. Younger investors have decades to recover from market downturns, while older investors need more stability and income. But here's what I want to emphasize. Age isn't everything. Your personal risk tolerance matters enormously. We spent 4 weeks on risk tolerance earlier in this series for a good reason. The right allocation is the one that you can stick with through bull and bear markets without losing sleep. Now, how do we bring duration, what we learned about last week, into the conversation? And this is where last week's discussion becomes practical. If you're investing money that you'll need in 3 years, a bond fund with an average duration of 10 years exposes you to unnecessary interest rate risk. A shorter duration fund of 1 to 3 years better matches your 3-year investment time horizon. Conversely, if you're 30 years from retirement, you can accept longer duration bonds that typically offer higher yields. So the lesson is to match your bond holdings to when you'll actually need the money. Now, when you look at bond funds, you'll encounter several major categories. There are many, many flavors of bond funds. Treasury bond funds investing exclusively in U.S. government debt, which is the safest bond funds available, but they'll typically offer the lowest yields. Corporate bond funds hold debt issued by companies, offering higher yields with more credit risk. Municipal bond funds invest in state and local government debt with interest that's often exempt from federal taxes, which is particularly valuable for investors in higher tax brackets. Total bond market funds, well, they blend these categories, offering broad diversification in a single holding. Now, we've covered a lot of ground these past 14 weeks. We started with the simple concept that all debt is a promise, whether scratched on Mesopotamian clay tablets or encoded in a modern bond indenture. We traced sovereign borrowing or government borrowing from the Fugger bankers to today's treasury market. We learned to read yield curves and learned about credit ratings, and we discovered how duration measures interest rate risk. The bottom line is that the fundamentals haven't changed in 4,000 years. Lenders still evaluate borrowers. Interest still compensates for time and risk. Trust still underpins every transaction. What has changed is your access to these markets and your ability to use them wisely. You now have the tools to evaluate those ancient promises for yourself. Next week, we shift our focus back to equity securities. While we covered the history of stock ownership earlier in the series, we never really explored the mechanics the way that we have with bonds. Over the coming weeks, we'll dig into how stock prices actually work, what shareholders truly own, how dividends function, and how to measure and understand equity risk. It's time to give stocks the same thorough treatment we've given to bonds. Till next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your family, your neighbors, and maybe a colleague. The show was produced by Nick Temte, and we'll see you next week on Money Lessons.